The headlines say markets are in turmoil. Maybe you're confused, frustrated, what you should do about it, and what's going to happen next. Hey, what's up, ladies and gentlemen? I am here with my good friend, Marshal Johnson.
Hey.
And this is an opportunity for you to join us for our Friday special editions of the podcast, which is our weekend reading for retirees email series, where we highlight one of the 4 articles that we send out every single Friday. And we send these out on a variety of topics. Lately, we've been focusing a lot on the markets. Markets are in turmoil. That's what we're going to be covering here in just a moment. But historically, we provide a wide variety of content. There's some really good stuff in the latest email that we send out. Marshall and I read dozens, if not hundreds of articles every single week. We sift those down to a handful, put those in your inbox, quick breakdowns. If you want to dive deeper, you can click the button, go on deeper into the article, share it with your friends. But that's not all you're getting. You're not just getting great articles. You're also getting event invitations, webinar invitations, book giveaways, quizzes, all types of great stuff direct to your inbox. If you'd like to sign up, all you have to do is text us, WR, that's WR to 866-482-9559, or just visit retirewithpurpose.com. So this week, we were kind of torn between a couple of different articles.
Good content lately. Sometimes it's harder to find the content, but lately there's just been some really good stuff out there.
Well, usually, we'll narrow it down to 4, and then I will do some further narrowing down to 1, maybe 2 articles and send those over to you. I sent all 4 to you, and I said, I don't know which one to choose, because they're all so darn good. We ended up narrowing it down between the 2 of us to 2 different articles, one from the Irrelevant Investor, another one from Creative Planning. I think we're largely going to focus on the Creative Planning article, which is titled Markets in Turmoil, but we may leak a little content from the Irrelevant Investor in there for you every once in a while. But we really decided this is the most timely thing that we can focus on, and that's what we try to do in these Friday editions of the podcast, is give you something that's trending, something that you can utilize to make better decisions right here, right now. And I think it makes a lot of sense for us to continue to focus on the markets at this point in time, especially because these articles really were fantastic.
Yeah, they're fantastic. And they help give perspective, right? Like anytime you're facing a challenge, let's get some historical perspective, right? Like history's not going to always repeat itself, but it tends to rhyme, right? So markets in turmoil, well, that's a headline that we've seen before, right? Yeah. Actually, we've seen it maybe over 100 times in the previous dozen years on CNBC.
I would say that's just from one outlet.
Yeah, that's just one outlet,
and
CNBC.
I'm pretty sure that CNBC is not trademarked markets in turmoil.
They might as well, right? Because they tend to run a lot of articles that say markets in turmoil. Well, they ran one about a week or so ago, and Peter Malik from Creative Planning here references that at the back of the article. I don't want to give away the punchline, but the reality is that this happens, right? And when markets are in turmoil, the questions pop up, and it's like, how long is this going to go on? What's going on? What should I do? What should I be doing with my portfolio? It's scary, right?
Yeah, and I don't know that there's a very clear definition of what markets in turmoil really means, right? It could be one bad day, it could be a really bad week, it could be a really bad year, a really bad month. There isn't a clear definition.
It's like a scary movie, right? Yeah. This is like, going in, it's a scary movie, either based upon, it's an M. Night Shyamalan movie or something. Yeah. It's going to be spooky. It's going to be,
you think it's going to be spooky, right? And quite often, I know my favorite M. Night Shyamalan movie of all time was The Village. Ooh. I probably watched that 50 times because it was the only DVD I owned in college. And so I watched that thing over and over again.
Wasn't that something when you were just limited by what you had on hand? It's like, I don't even know if I really like this movie, but it's
Netflix
one of the 5,
was not an
right?
option at the time. There was no Amazon Prime for me to turn to. So I was stuck to The Village, right? And you just start watching that movie, if you remember, you're going, oh my gosh, this is terrifying. There's monsters in the woods. And it turns out there were monsters. It was a bunch of humans running around with
playing a prank.
Something on their head, right? It wasn't even...
That's like the markets, right?
It was a total bummer at the end of the movie, but I continued to watch it over and over again because it was really exciting.
There was good news at the end. It's like, oh, we're not all going to die.
And there was an interesting storyline. There were interesting things that happened throughout. It kept me engaged.
Yeah, it kept you on the edge of your seat, right? It was suspenseful. And that's what we're dealing with right now.
We may be in an M. Night Shyamalan movie, right? There may be a big twist at the end.
This is not Stuart Little, though.
And there's some crazy things going on.
Did you know that he directed Stuart Little?
That is the weirdest thing I've ever heard. But this is like that. There's so many strange things going on in the market that it is fun to talk about.
Spooky.
It is fun to read about. It is interesting to really uncover because there's just there's a real dichotomy of different things that are going on in the market right now. And so we want to ask ourselves, all right, what's going on in the market? Is it really in turmoil? How should I be reacting? What should I be doing at the end of the day? Should I be scared, or should I just continue to stick with my strategy?
Yeah, I'm just laughing still about the Signs movie where he like breathes cold air, and that's when he sees dead people. So my son, every time it's cold out, he's like, Dad, look.
I think wasn't that the Sixth Sense?
Oh yeah, Sixth Sense. Yeah. You're right, not
Close.
Signs.
I think that was
Sixth
about
Sense.
aliens, but it wasn't really aliens.
But maybe that's what's going on here. It's like, oh, Netflix is down 74%. Oh, I see my breath. Is this a ghost?
Business.
Is this a ghost?
Yeah.
Is this
Crypto's
Luna?
going to zero.
Is this Luna?
Yeah.
Is this a crypto ghost?
So let's talk about the S&P 500 itself. I mean, we're sitting here currently, it's May 24th. So it's Tuesday. This is going to be released here in a couple days. And for us, where we currently stand, markets S&P 500 down around
16.63.
Yeah. So about 15%, right? Not a far cry from what we saw on May 8th, where the market was down around 14% when this article was released.
Right.
And the question being asked is, how bad is this? I mean, how often do we see this? Are markets really in turmoil? Depends on how we define that. But I would argue if we see this happen about once a year, if we look back throughout time, you're going to see since 1980 through today, over 40 years, basically that happens about once a year where the market's down around 14%. If it's beyond that, say 20% or over 15%, we're seeing that happen every couple of years over the last 40 years. So
at some point, yeah.
It's something that happens quite regularly. And what'd you say about cash, right? Cash being on the sidelines, scared cash
scared money don't make money.
Scared money don't make money. I like that, right?
Well, cash, that's a teaser from another article,
well, here's the ideal point of that. I think you could look back at 2020, market's down 34%.
Yeah,
market ends up 16%. So what happens if you were fearful when the market was down 34%? You went to cash.
Yeah, you missed out on a huge run. And we go back through this chart here, we can see all the period of times when cash was really high. And I can't believe we're at those levels, March of 20 levels. The market was down 34% at that time. We're down 15, but it feels worse.
Well, here's the thing. I don't think that I would say markets aren't in turmoil. I think markets are down. I would say markets aren't in turmoil. I would say investors are in turmoil.
Yeah, there you go.
And the reason I say that is because of what happened in 2020 and the way investors have become allocated over the last decade.
A little more speculative.
Yeah, well,
right?
One, you've seen a lot of advisors, portfolio managers reaching for yield.
Yep.
They're reaching for yield, taking on more risk. They're exiting those bond positions and reallocating those fixed income positions to avoid interest rate risk and to pick up additional yield. Allocating those dollars to equities. And in 2020, we saw a lot of investors that not only got more aggressive, but allocated to things like cryptocurrency and NFTs and entered the more speculative points of the market, SPACs. And I know for me, a lot of my circle that I tend to run in, a lot of investors, they were getting into some very high-risk private investments. And we saw investment clubs popping up all over within this group. And they actually had me speak at one of their events. And it was one of their summits. They wanted to cover investing. The other guy is talking about, private placements and private investments. And I'm going,
and you're like, wait a minute.
Why don't we just focus on common sense? Because most of the people that are actually at this summit aren't at a point where they can afford to take that risk.
Yeah.
They are at a point where they have their own financial stability taken care of, where they have a base plan. They have something to fall back on if we get the worst, because we could get the worst. Right now, being down 15, 20%, well, at the end of the year, we could be down 50%.
Yeah, sure.
There's unknowns out there. I think it's unlikely, given what we do know.
What we know.
But we don't know what we don't know.
That's
what we have to be prepared for as investors. We always need to be planning for the best, but preparing for the worst. So if you're still with us, we're going to talk a little bit about some of the big takeaways from this article.
Yeah,
that
we
I think
just
are a lot of
skipped
fun.
like 15 pages of the article, but there's good stuff in there.
There's
but
fun stuff in there, but you don't need to know it all.
You come back to the summary and say, he says, so to recap, so far we've got a normal stock market correction, but there's more bloodbath and speculative parts of the market. And that's really what he's talking about. Crypto down, Bitcoin down 50, crypto index down 59, tech stocks down over 20.
There's some parts of crypto markets that are down 100%.
100%.
Went to zero, right? And so they're FANG stocks down 40.
And I think that's a good point. Like, we talked on last week's podcast about, baby boomers are waiting for millennials to start, investing in the market. And they kind of went the other direction and kind of gamified investing. And they're taking, YOLOing into Bitcoin or whatever the next meme stock was. These are things that can end badly in the short term with all that speculation.
So what may happen? The markets are concerned about what? They're really concerned at the end of the day that the Fed's going to overdo it, because the economy as a whole. You read articles, the economy is not in a good position. I got to argue. Most indicators point that the economy's in a pretty good position right now. Just like we talked about during our last podcast, it's really all about interest rates right now.
Yeah, corporate balance sheets look really, really good, right? We're seeing tremendous, earnings are still strong. Expect those to go down, right? Yeah. We expect earnings to go down, and maybe we're even headed towards a recession, right?
We might already be in a recession.
We might already be in a recession,
but
right?
that's something that happens quite often.
Yep, but the labor market still looks fantastic. Actually, it's not fantastic. There's 2 open jobs for every one job
it
seeker.
Depends on which side of the market you're on there.
It's almost like a M. Night Shyamalan script here, right?
Well, and then you have the inverted yield curve. We just did a Market Outlook webinar. You can catch it on our YouTube channel.
A recession's
where we
coming then.
Did have some questions about the inverted yield curve, saying, how concerned should I be that in the curve, the yield curve is inverted? That means we're headed into recession. You go, we were in a recession in 2020. Markets turned out pretty good. There's been a lot of times we've had an inverted yield curve where the markets have actually turned positive by the end of the year. So not a direct indicator of recession, and far from a direct indicator of what the markets are going to do in the short term, but it's something that catches headlines for that matter. So we have unemployment rate, the lowest it's ever been. As you said, Marshall, 2 job openings for every unemployed person. That's unbelievable. This is not the 2008 financial real estate crisis.
Yeah, I think that's where we were kind of headed, right? We're not on the brinks. The corporations' balance sheets look really strong. The only balance sheets that don't look strong are governments, right? Governments have transferred
There's
so
not
much
a massive
money
amount of over leveraging going on right now.
From their assets from their balance sheet, and then they pushed it out to consumers and corporations.
And now they want it back.
PPP. Think about all the PPP loans and stimmy checks that were flowing last year. I mean, people were flush with cash. They've started to spend some of that cash, but personally, our balance sheets look strong. So if we are headed for a recession, there's some bright side there.
Yeah, and to put the extra nail in there on the home thing, there's a shortage of 3.8 million homes needed to meet current demand. So we're not looking at a housing crisis right now. I mean, Marshall, you and I talked about this. Well, first, a recession's never happened with this mix of factors. So let's go ahead and throw that in there. Doesn't mean it's not going to happen, but we've never seen it happen with this mix of factors.
Current cocktail.
With the current cocktail that we have going on right now. And then what does the Fed want? You might argue that the Fed actually wants a recession. You might also argue.
How do you clean up that labor market, right? Well, in a recession, typically there's layoffs and, the number of job openings declines. Well, that could maybe even that out. That'll help inflation.
It's all about supply and demand, right? And so how do we get gas prices under control? We enter a recession. How do we get goods and service prices under control? I mean, you could talk about a lot of different factors, supply, disruption, et cetera. However, a good way to get those things under control is to just reduce the demand, right? And a recession can help reduce
Economics
that demand,
101.
tip us into a minor recession, we get inflation under control, and we're back on a good run. That doesn't mean it's a soft landing. That might mean something a little bit stronger than that.
Well, I was going to say, I think a Fed's definition of soft landing might be just that. It might even be a recession, just a mild recession. To me, that's kind of what they're shooting for at this point, but maybe they don't do enough, right? So that's the other option. So the Fed doesn't do enough, inflation stays strong for several years.
I mean, what do we do with our money if we see soft landing? What do we do with our money if we see that inflation stays strong for several years? So what tends to perform the best in those environments?
Stocks, real estate, that sort of thing.
Yeah, investments, right? Our risk on assets are going to tend to perform the best, just like they do over long periods of time. And that's where I would fall into the third category. The Fed overdoes it. We turn into a severe bear market. What happens?
Yeah.
Well, long term, our investments, our equities, our real estate historically have still been our best performing assets.
Sure.
And if you're going to cash right now because you're scared of what's going to happen next, you have to make two decisions. You're making one to get out. You have to make one to get back in. And the majority of the time, you're probably going to miss the opportunity to get back in the market.
Right. Market timing just is not the answer.
No. And we also have to keep in mind, this is what we plan for at Howard Bailey, are the unknown unknowns.
Prepare for the worst, right?
It's what we talk about all the time here, is that you don't know what the markets are going to do. You can't pull out a crystal ball, and you cannot look at market indicators and make good decisions about what the market's going to do over the next 3 to 6 to 12 months, because there are unknown unknowns. We don't know if something terrible is going to happen that we could never predict, a cyber attack, a new virus, an expansion of a war in Europe or elsewhere. Good things could happen too. We could have all of a sudden China and Asia decide to open back up. We see a peace agreement between Russia and Ukraine. Maybe we have a major technological breakthrough. I mean, there's any number of things that could lead to a massive breakout or a break to the downside at the same time, right? And so the smart investor does what? The smart investor is creating a plan. And that plan allows you to stay invested in the markets during these periods of time so that you don't have to time the market, because you do have that fallback strategy, and allows you to endure these periods of time. And many retirees, they've exited their working years and reallocated in the retirement years to a portfolio that's not much different than what they had during their working years. And that doesn't drive peace of mind. When you were 30 and investing in a 60-40, 70-30 portfolio, who cares? When you are 65 and depending on these dollars for retirement, and you don't have a fallback strategy to fill that income need for the next 5-10 years, take care of your emergencies, take care of your health care needs. If you don't have that fallback strategy, then you're probably in panic mode right now, and that should be a red flag.
And not to mention the fact that 40% that you allocated to bonds might be down 10 to 15 to 20%. So that's why I think it feels the way it does. But there's some great charts in here. The next one talks about what happens after the first Fed rate hike. I think a lot of retirees would say, oh, the Fed's raising rates, the market's going to be a mess. Well, over the next 3 months, there tend to be a few negatives in there, but 50% of the time it's positive over the next 3 months. After the next 6 months, 75% of the time it's positive. After the following 12 months after the first Fed rate hike, the market is positive 100% of the time.
Yeah. And I would emphasize, if you're looking for a bond alternative and you're not sure where to turn, go to episode 58 of the podcast. We interviewed Richard Cato, the inventor of the fixed indexed annuity, where he showed and illustrated how he built his own portfolio for this very circumstance, for a rising interest rate environment where he had some bond alternatives. That doesn't mean we completely eliminate our bond exposure, but we look into alternatives such as that, or owning individual bonds. There's a lot of different things that you could do to protect yourself against these types of periods, especially when you are in retirement. And let's end with markets in turmoil. Let's bring this to a close.
Yeah, CNBC had an article last week titled "Markets in Turmoil," something they've done more than 100 times in the last dozen years.
It's crazy. I mean, I feel like I see it all the time. I'm on my CNBC app every single day.
100% of the time, the stock market finished positive over the next 12 months.
100% of the time.
Get out of here. 100% of the time. Look, we got the data here, the
Now,
hard data.
I don't know if it goes back far enough. I mean, if we could take this back to
it's
2007,
right.
2008,
1920.
1999,
Go back to
2003.
1920. Right.
Like, I don't think we can take this back far enough to really see or have a fair assessment.
Well,
but I think this
check your
is,
sources too. I mean, this is one of the largest RIAs in the country, right? So they're trying to keep their clients invested in markets. What you were doing is not. You're saying, hey, there are alternatives out there. Diversify your fixed income. Look at some of these alternatives. Yeah. We're not trying to appease everybody and put on rose-colored glasses and say, well, the market's going to be up.
Well, that's the problem with the majority of, well, as my dad would say, investment advisors. He would often get frustrated, through the late 90s, through the early 2000s. I would often hear him say, I just don't understand why, someone calls their broker and they say, just sit tight, just sit tight. It's like, no, there's always something you can do to take advantage of so-called turmoil in the markets. I mean, even when we look at this, it's like, yes, there has been turmoil in the markets. The markets are down. That doesn't mean that you just look at it in rose-colored glasses, go, hey, the market's always positive over the next 12 months. There's still things that you can do to take advantage of these opportunities. One being, very simply, do a Roth conversion, right? Take advantage of depressed prices, to pay taxes today, do a conversion. Look for depressed, areas of value in the market. There are opportunities and things that you can do when the market's down. And a lot of brokers or individuals, investors that are only working in the equity side of the market or working directly on Wall Street, they're going to say, just stay all in, don't do anything, right? They don't want you to sell. They don't want you to make a change. They don't want you to leave and go to an advisor that's going to provide you with a more robust plan so that you actually never have to worry about these things again and you can just go about your life the way that you're supposed to go about it. And that's living in the moment, living today, enjoying today, not worrying about what's going to happen tomorrow, and not worrying about what happened yesterday.